Yeah, our stock of the day is Pinnacle Investment Management. Has been one of the best performers this morning on the ASX on its outlook, which is saying it's cautiously optimistic about the second half of fiscal 24. Has since actually come back since the opened with a bang there. Josh, when you take a look at Pinnacle, it was formerly Wilson's Group, Financial Services, Investment Management. It's been a difficult space. How do you look at, well, let's start specifically with Pinnacle and perhaps get your view more broadly on the investment managers.
Yeah. So today's announcement was just a brief market update, kind of highlighting some numbers that they're going to rake in from their performance fees. So expected to receive 12.3 million from their various funds. And I think one positive on today's announcement was the variation that they've got within their funds. So they've got the ability to sort of outperform depending on, and get those performance fees depending on which asset class does well. So I think that's a positive that you can take. And I think obviously the headline number, getting those inflows through performance fees is something that's fairly rare with the fund manager space at the moment. However, it has given up a lot of those gains, got off to a flying start. They mentioned towards the back end of the update, they'd spent a lot of money sort of in tech. So they sort of worked on the Open Invest platform, which is a wealth management platform essentially. Seems really interesting, but unfortunately, they've had to do a write-off, which is effectively an accounting term for losing money. They've put sort of over $3 million into it, and its rough value is 240 grand at the minute. So, expenditure in tech and the fintech space specifically, somewhat evaporates a bit of that profit that they're going to get from the performance fees. So perhaps that's why we're seeing the volatility. There's positives and negatives in today's announcement. Broadly, we've steered away from fund managers. Obviously, in a tough market, they're benefiting from performance fees. Obviously, if the market doesn't reach a higher watermark, they're not going to get those performance fees over the last couple of years. And then obviously a downgrade in personnel, and it sort of all flows on through there. So it's not something we've looked at, and I think even moving forward may struggle and be a little bit behind the trend of the market. Market boosts, obviously that impact will flow through to these fund managers, but it's not an immediate benefit. It's going to flow through over maybe 6 or 12 months. So not a space that we're overly interested in being in at the minute.
All right, if you held at those, are worthwhile holding onto it, do you think?
I think it's worthwhile holding on to if you've experienced. It's a really strong performer in a bull market, as we've seen over a sort of 10-year period. And it's really just consolidated sideways after such a great movement. So I don't think you're necessarily too concerned about your position, so I'd be happy to hold.
Good one. Luke, your view on Pinnacle?
I agree with that. I think it's a hold as well. The consolidation sideways basically mirrors the fundamentals of the business, even though, the broader market and for a lot of other listed fund managers globally, it's been a very tough time, particularly with fund outflows, headlined by Magellan, of course. These guys have basically gone sideways. And it's a testament to the way Pinnacle's run. They have investments in a range of different fund managers, and they spread that across asset classes, geographies, and also size. And so if they do their job well, then it's a business that can sort of weather those storms. As generally speaking, some asset classes will outperform even in tougher times for others. So you read the announcement today. Again, I think Josh has summed it up quite well, which is that headline performance fee returning quite strongly. Pinnacle will recognise about $12 million to them as a share of their ownership in the fund managers. Last year that was about $1 million. So you can see strong recovery there. And of course, they sort of tempered that with, as Josh pointed out, a write-down in a tech investment they'd made, flagged some higher costs, and also they've got some debt, which now some higher interest rates are starting to bite into that a little bit. So, look, I think, the announcement is sort of business as usual, and the share price reflects that. The market has probably front-run a return to performance fees given the performance of the market over the last couple of months. And they highlighted that I think 8 of their affiliates were crystallised in this period, but the full 25 are, within a cooee of their high watermark, if not above it already, and have the chance to crystallise performance fees into the second half of the year. So currently trading on 26 times earnings. I think that's factored in, but it's pretty easy hold here for me, given the quality of the business and the job that this team's done of, as I said, building out a business can weather the storms of a normal fund manager.